As the markets price in further rate rises from the Federal Reserve, technical analyst Ron William from RW Advisory is asking, is the US dollar, the king of currencies, dead or alive? Ron, welcome.
Hi there, Jeremy. Good to be back.
This is a big philosophical question in my mind. The dollar is, of course, enormous amounts of history. It's been a traditional safe haven, and it's almost got a dynamic of its own. Give us some background as to your thinking.
Yes, well, I mean, the trend has been dead for most of this year, and year to date it's down almost 13%, and actually, statistically, it's one of the worst performing years, 2017, for the dollar since 2003. So for good reason, a lot of people have been selling the dollar. But on a macro fundamental basis, there is a reason why it stopped behaving the way that it always has done. And partly, it's been depressed, historically low volatility, so less use of safe havens in general. But two, of course, the Federal Reserve's ongoing interest rate hike policy has disconnected the old relationship, especially with its counterparts in Europe and Japan doing the opposite, and the differentials widening. So that has pressured the dollar lower.
Yeah, you brought along 5 interesting charts. We're going to start off on the dollar. We'll talk a little bit more about safe havens in the context of the yen, as well as gold. But we're going to kick off first of all with this chart. Very, very busy chart. You're going to have to take it apart for us. Explain what's going on.
Yes, well, let me first start by dividing it up. There are 3 parts to this chart. The top part, part A, is price. Second part, B, is just time cycles that I use in the background. And C, last but not least, is momentum studies. But the main chart here is the price chart. And that's just showing what we've already been discussing, that the dollar has been down year to date and is now resuming that downtrend, but it must break 91. That's the key level on the low side, which is a 2.5-year, close to 3-year low on the dollar. And so this is what needs to happen. But in and around all of that, a trend is only your friend until signs of a reversal emerge, and that's basically the thesis of my view at the moment on the dollar, partly because of this pattern. And if you just notice the numbers on the pattern, 1, 2, 3, 4, and then a 5th one coming in, it's an Elliott wave pattern, basically mapping out crowd psychology, and it suggests that this dollar trade is indeed overcrowded. And that's the very thing you need, an overcrowded trade which produces an exhaustion zone into that new low that we're likely to see, and I'll explain a little bit more on future slides as to why that new low is important. And certainly something we should be looking at the flip side for a potential bullish reversal into the new year, and that's what the timing cycles are showing there on the second panel, panel B. Yeah,
keeping on this chart, first of all, you've got an inverse head and shoulders mapped out here, which has failed at 0.4.
Yes, so this has caught out a whole lot of people. I mean, I was also looking at this myself, thinking that this would play out initially, but in the end it completed a counter-trend rally, which fed through to the wave pattern model that we're looking at. And essentially we're still, that pattern is still active because it's still on the right shoulder of the pattern at 92, I believe, or thereabouts. Yeah. And if we were to break above 96, then this could play out in a different way, in a more bullish, immediate manner. But for now, it's looking more likely that the trend will persist in the near term and produce a marginal new low. But it's very important that everyone keeps in mind that marginal new low is a completion of this bear pattern, which will likely flip to the upside in the new year.
Okay, very quickly, stay on this chart. 91 is your point of support here. You're saying that's going to hold? That's your expectation?
So either it holds, or actually my expectation is that we make a new low, but a marginal new low, and that will create the exhaustion in the market,
right, okay,
the vacuum, the price vacuum that's required in order for the cycle to flip from down to up.
Okay, all right, so let's bring up the second chart, because this is a chart that goes over 18 months. You've got a longer term chart here that goes back into 2014. Yes,
so I know most traders, of course, are trading the intraday and very rarely look on the weekly or monthly time frames, but this is why it matters, because of course all time frames influence each other. There is a domino effect. And here, despite the year-to-date downtrend that we've been in on the dollar, and most people talking about the dollar losing its reserve currency status or no longer playing out as a safe haven, it's still sideways. If you look at the last 2.8 years, or almost 3 years into the new year, we are still sideways. And that's why I was cautious about the level at 91 being too bearish, because actually 91 and 88 are retracement levels of the big bull market in the dollar since 2008, and that's our next chart.
Yeah, that only looks actually about 50, probably 61% retracement, is it, from the lows to the highs? So yeah, you've got some Fibonacci's in play here as well.
Yes, and these are risk levels to gauge for, 91 and 88. So beyond 88 is when I start to reevaluate this view. So it could serve as a stop loss, you could say, yeah. But 91 and 88 are the risk levels.
Okay, let's move on to the next chart as well, because this takes us along this story. Now, this is our last chart. We are just looking at the US dollar. This is a far longer term chart, and you've got this 5-wave action on the chart here. Explain more. So
markets behave in a fractal manner, especially across time frames, and this is the larger degree of the pattern, and it shows that since 2008, since the global financial crisis previous, which is almost 10 years now, to that time, the market has been up. So we are in a decade-long dollar uptrend. That's what the facts tell us, the technical facts. And right now, if we were to, and that has been a 5-wave ascent, part of the reason why we had this very difficult year for the dollar is because technically it had completed this Krauts pattern, looking at the chart. The risk levels are 91 to 88, and that would still maintain the uptrend and still also keep in line with the Gann regression lines I've drawn there on the low side. And something to keep in mind, but what this actually does suggest going ahead, particularly in the new year, is that there is a new cycle ahead. So this is one that has completed, a new cycle ahead, which I believe the probabilities favor on the upside. We have to wait and see how the market behaves, but I think this will become increasingly important, particularly if we get a return of volatility, and that's what I'm looking for early in the new year, but more so second half of next year.
Before we leave this one, very briefly, this Elliott wave, the yellow 5 lines you've drawn on here, green is the first of a 3-wave correction?
Yes. Yes. Thank you for highlighting that the phase that we're seeing now is a corrective stage, but it creates a reset for the new cycle ahead. Right.
Okay. So let's move on to the next chart, and this is where we start to broaden out a bit, because you start now to bring in the yen, and you say here on the left-hand side here, top safe haven.
Yes, well, according to this yield chart here, showing basically this reversal of
this is the box in the bottom left-hand corner, isn't it, here?
Yes, it is, and it's showing so this small box in there titled box B just shows basically the yields on the currencies, and it shows this wild swing rotation that took place early this year between the dollar and then the Swiss franc and the yen. So usually in terms of currency yield, from negative to positive. So that's just showing you the correlations on the scale there. And what it shows is right now, Japanese yen is in the lead as the top safe haven, hence the title that I used. But my point going forward is that we might get a mean reversion back to the old relationships if the dollar actually plays up to the upside, and ultimately volatility returns, because let's face it, historic volatility has been so low. We're comparing apples and oranges, really. If we talk about 2008 and 2000, last time we had significant financial stress in the market.
So, levels to watch out for here: 107 support, 114 is resistance.
Yes, so the dollar yen is range bound for the most part. We're looking at the moment that we will likely test the low side of that range, which it's been in since spring of this year, so almost a year now. And that is at 107 or 106.60. And that would just basically be weighed down, pressured further by the long-term downtrend on the yen. Having said that, of course, in line with what might happen in the market, if we get a little bit of a rock in the market, the yen will likely continue to play its safe haven role.
Yeah, talking about a rock in the market, let's introduce gold into the discussion and go on to the next chart, because gold, if there is, as you say, a rock in the market, this is where it could well play out. But if we see a continuation of low volatility and so forth, are we going to see more lows for gold? Explain what's going on here in the context of our discussion today.
Yeah, so gold, I mean, I think out of all of these markets has been the strongest on a very long-term basis, going back to its major lows in 1999, the so-called brown bottom. And right now, again, we've been sideways on gold, and we're actually been testing the low side in the last few days. But it is part of a rounding bottom, saucer bottom, as we say in technical analysis. All that shows is there's a little bit of a accumulation going on in the market, and buyers are coming in despite what we saw in the last few days over the medium term. There are key trigger levels to watch out for. 1420 on the top side, 1060 or even 1000 on the low side would be a key psychological level. I know that's some way from where we're trading at the moment, but we're talking about the big price support and resistance levels here. This is more a bullish pattern, and if we were to break on the upside, that would likely get a very sharp move up to 1800. That's what I would call a quantum move to the upside, and be very bullish for gold. And let's also keep in mind the Gann regression line I've just drawn in there, showing that gold is literally sitting on that line in the sand, as it were, that equilibrium line, showing that the trend is still up, but at that make or break level.
Yeah. Okay, so key levels to watch just below where we are at the moment at the big 1000 level, 1420 on the upside. In terms of your calls for 2018, can I just return to the big picture now? So you're bullish dollar.
Yes.
And you are short on yen.
Yes.
And for gold?
Well, for gold, of course, this is the contrarian view, because I continue to look for a bullish call on gold, but then that would come in opposition to a bullish view on the dollar. And my reasoning here is it isn't the first time that the dollar and the gold rise at the same time. Traditionally, there is an inverse relationship, but that relationship breaks down for two reasons in history. One, depending on the location of the cycle or the trend. In this case, the dollar is so overcrowded, so oversold, so on a relative basis, one might outperform the other. But the second reason, this is actually more in line with my thesis for the new year, if and when volatility returns early new year, but more so second half of next year, then that will produce a fear trade, and in which case people are indiscriminate and they're likely to buy both the dollar and the gold.
Yeah, look, okay, Ron, it's an interesting call, but thanks so much indeed
for
joining us. Ron William from RW Advisory there with his look into 2018 from a technical point of view on the markets.